Now the final part of the chapter is international diversification through the several different funds. So the first one is the country funds. So recently, country funds have emerged as one of the most popular way to invest internationally. The country fund invests only the stock in one country, single country. This allows investor to speculate in a single foreign market with minimum cost. So if you want to speculate certain market, then you can actually just investing in this stock, in this actually funds. You can also you can construct your own personal international portfolio with several different country funds, and you can diversify into emerging markets that are otherwise practically inaccessible. However, the majority of the country funds available has the closed-end status. What is the closed funds? The closed fund is the funds that issue a given number of shares that are traded on the host country exchanges as if it were an individual stock. These shares are not redeemable at underlying net asset value set in the home market. So this is also called the closed-end country fund, CECF, closed-end country funds. The CECF issues a given number of shares that trade on stock exchange of the host country as if the funds were an individual stock by itself. Unlike shares of open-end mutual fund, shares of closed-end country funds cannot be redeemed at the underlying net asset value set at the home market of the funds. So basically, this is the funds that you cannot redeem at underlying net asset value set. This is the US and home market betas of the closed-end country funds and their net asset values. So currently about 30 countries offers the CECFs. This is a partial list. In the United States, the majority of the CECFs are listed in New York Stock Exchanges. Few listed on the American stock exchanges. Since the share value of the fund is a set on a US stock exchange, it may very well diverge from the underlying net asset value, which is called NAV. This is NAV, set in the fund's home market. The difference is known as a premium if the fund's share value exceeds the NAV, or a discount in the opposite case. The table now provide the magnitude of the premium, the first column, or discount for the sample closed-end country funds. As shown in table, the average premium varies a great deal across funds, ranging from 63.17%, which is the Korea funds, to negative 24% for the Brazil funds. Like the Korean funds, the Taiwan and Spain funds have a large premiums, 37.89 for Taiwan, I believe, 21.57% for Spain. Mexico funds, pre-discounted, negative 21.14% on average. It was also observed that the fund's premium discount fluctuates widely over time. For example, the Taiwan fund premium varied between negative 25.27% and 205.39%. Most funds have traded at both a premium and a discount since their inception. The behavior of the fund premium implies that the risk-return characteristic of a closed-end country funds can be quite different from those of an underlying net asset value. Okay. So these closed-end country funds may behave partly like US security and partly like security of the home country, right? To investigate this issue, consider the following two-factor market model. So you can get the better of the US and better of the home country and run a regression. And the table in the previous slide also showed this result. So there's a better of US, better of the home country, right, and R square. So it tends to have substantially higher US beta value than the underlying net asset values. The average US beta value is 0.84, right, for CECFs, but only 0.25 for NAVs. On the other hand, an average home market beta is 0.46 for CECFs, whereas the 0.67 for the NAVs. In case of Korea, for example, the fund's underlying net asset funds has a US beta 1. So 1 versus 0.24 for Korean funds. So the funds versus the NAV, underlying net assets, 1 versus 0.24. Home country, 0.36 versus 0.76. In case of Thailand, so 1.2 versus 0.63, 0.44 versus 0.85. So it's pretty consistent. So CECF returns are substantially more sensitive to US market factor and less so to the home market factor than their corresponding net asset values. This means that the CECFs behave more like the US securities in comparison with the NAVs, the home markets. However, the majority of the CECFs retain significant home market betas too, actually, right? So it allows US investors to achieve international diversification to a certain extent. So it doesn't really mean that you cannot diversify. You can also diversify because it is also related to the home country underlying net asset values. International diversification through the ADRs. So you can also use ADRs to diversify internationally. There's advantages comparing with the direct investment. ADRs are denominated in US dollars, traded on US exchange, right? And can be bought through any brokers, and dividends are paid US dollars. Most underlying stocks are bearer securities, and the ADRs are registered. So adding ADRs to domestic portfolio has substantial risk reduction benefits. And this actually gives a substantial risk reduction with easy trading. So that's benefit for ADR. What about ETF? So you can also use exchange traded fund, which is also called ETF, to diversify internationally. This ETF measure is like you can have the single country index funds. Also, investors can achieve global diversification just by holding a share of the S&P Global 100 index fund. So you can also hold the S&P 500 Global 100, which is another ETF, to achieve this goal. So don't have to buy on the several ETFs. You can also use hedge funds to diversify. So what is a hedge fund? Hedge fund is the private pooled investment funds that have experienced phenomenal growth in recent years. This growth has been mainly driven by the desire of the institutional investors, not really individuals, so large investors, to achieve positive or absolute returns, regardless of whether markets are rising or falling. So they try to achieve the positive returns using various ways to invest. So unlike traditional mutual funds, the traditional mutual funds usually just have the buy and hold strategies, hedge fund may adopt flexible dynamic strategies. Very aggressive, using leverage, using short position, derivative securities to achieve the goals. These funds may invest in a wide spectrum of security. Now, currency, domestic, foreign, stock, bonds, whatever, real estate, and so on. So many hedge funds tend to realize the positive returns even though the market's bad. So it tends to have relatively low correlation with various stock market benchmark. So that also offer the diversification. In addition, hedge funds allow investors to access foreign market that are not easily accessible. For example, JP Morgan, which is the investment bank, provided access to the Jayhawk China funds, a hedge fund investing in Chinese stock not readily available in the United States market. So you can access to the Chinese market using these hedge funds. Hedge fund may allow investors to benefit from certain global macroeconomic events. Example of the global macro funds include such well-known name as the George Soros quantum funds, Julian Robertson Jaguar funds, and the Louis Bacon's more global funds. So there are a number of global macro funds you can find in this market. Legally, hedge fund a private investment is partnership. So these funds generally do not register. It means that you don't have to really report or disclose your relief from these requirements. But it's risky too, so you have to be careful. Hedge funds may make wrong bet based on incorrect prediction of the future event or wrong models. It's pretty risky, right? Also, the failure of long-term capital management provides an example of the risk associated with hedge fund investing. Hedge fund advisors typically receive the maintenance fees, often about 1-2% of the fund asset values, as a compensation plus a performance fee also that can be 20-25% capital appreciations. Investor may not be allowed to liquidate their investment during certain lockup periods. So, I mean, they need to have time, right? In the US, only institutional investors, wealthy individuals are allowed to invest in hedge funds. So most individuals cannot invest in hedge funds. In many European countries, however, retail investors are also allowed to invest in these kinds of hedge funds. So you can use hedge fund to diversify too. Now, home bias. So we can clearly see the bias toward the home market, which means that if you're a US investor, then you have higher proportion in the US market. If you're a Korean investor, you have higher proportion in Korean market. So it's not really, if it's perfectly efficient, right? The investor can potentially benefit a great deal from the international diversification, but actually many investors are quite different. Home bias is one case. So this table actually shows the home bias explanations, and most country funds pretty heavy weight on their home country. So what is the possible explanations? So domestic equities may provide the superior inflation hedge, right? Home bias may reflect institutional legal restrictions on foreign investment sometimes, because sometimes you can have more restrictions in your country than you are more linked to the domestic investment. Extra taxes, transaction information cost for foreign securities also may give rise to home bias too. So there are recent studies. The recent studies of the brokerage record of tens of thousands of US individual investors shows that the wealthier, more experienced, sophisticated investors are more likely to invest in foreign security. So that's pretty common, right? Because you can have more information, better expertise, more money, you can actually invest more internationally. Another study showed that when a country is remote and has an uncommon language, foreign investors tend to stay away, which may be possible because the language is too unique. Many investors don't understand the language, then you probably go to the country that whose language is English, right? Because the information is a lot easier to understand, less costly. So finally, you can also diversify using the small cap stocks. Many investors they don't tend to use the small cap stocks actually. They usually use the large cap stock, but current research suggests that investors also can clearly enhance their gains from international investment by foreign small cap stocks investment. So now investment companies have introduced many small cap oriented international mutual funds too. So you don't have to only use the large cap stock. You can also use the small cap stock to invest internationally. Okay, so this is the end of the chapter 15, international portfolio investment. Thank you for watching this chapter. Goodbye.